Hey, what's up everybody? It's Mike Malbrough. Welcome back to Wallet Reset. And in this video, we're going to talk about how to invest in stocks when you're brand new and you have very little amounts of money. Okay, so before we get into this, you know what to do. Hit the subscribe button. Also, make sure you tick that bell for notifications. And give me a thumbs up if at any time in this video you feel like you learned something or I said something that helped you out. And be sure to leave any questions you have in the comments below. So let's dive right into it. How can someone who has no idea how to invest in the stock market get started when they have very little money, right? So I, myself, recently, probably like the last maybe 6 months or 8 months or so, started to invest in stocks for the first time ever. I am extremely late, really, to the party, but investing in stocks is not difficult at all. It does take a little bit of study, but there's good news and there's bad news. So the good news is that because it's easy and because you can start with very little amounts of money, if you do this the way I'm going to tell you later, you can start out and not really risk losing a bunch of money, right? And so you really are going to have to practice whether or not you know what you're doing, which leads to the bad news. The bad news is that it's not going to be something that you just figure out. You're never going to know what to do. There's people who, literally every day their job is like, okay, I'm going to invest other people's money into the stock market. Like, for example, Warren Buffett he owns a brokerage, essentially, where he buys and sells companies or stock or what have you. And he still, at times, will have fluctuations. So you have to be able to understand not just the stock market, but that the stock market really is just a reflection of a couple of different things, right? And ultimately, what you have to do is understand that those things are, number one, right, the strength of a company, right? So when you go to buy a stock, you don't necessarily want to just buy it based on the fact that you can buy a lot of it for a very small amount. That's a little bit actually more risky because you can buy a stock that's like a penny stock and it can go out of business and you lose the money. So if you put, if you only had $100 in there, but you lost all $100 because you put it all on a stock that went out of business, well, then you just lost $100. If you want to get started, you have to understand that the business is itself the engine that you're putting your money into, and they're using the money that you've given them to grow their business. All right, and that means that the business has to have some type of strength to it. All right, meaning that they basically can't be in deep debt, right? They have to have certain signals, like they have to have equity, they have to have a good amount of income coming in. And it's really just like trying to understand if you were lending money to someone, like a person, right? If you know that this person never pays their bills on time or rarely ever pays their bills on time, you're not going to give them that money simply because you know that there's a less likelihood that you're going to get it back. Also, if that person might pay their bills well, but their job isn't really, is having some trouble. You may not give them the money either, simply because hey, this person is a really good person, they're very good at what they do, but the job just isn't stable. So it's really just like lending money out to people in a way. And it does take you having a student's mentality. So if you're going to learn how to invest in stocks, there is a resource that I use that I'm going to share with you in a moment. But first, I want to tell you what my strategy is for investing in stocks. So if you're here, right, if you're watching this, then you may or may not know who I am and what I'm all about. But essentially for me, I am the type of person that I like a sure thing, right? And one of the things that, one of the people that I really try to watch and understand a lot is Warren Buffett. And so Warren Buffett has a rule where you don't lose money, right? You don't lose money. Whatever you do, don't lose money, all right? And with the stock market, one of the things that's good is that you don't lose money unless you just sell at the wrong time. If you get emotional and you sell at the wrong time. But what I like to do is I like to approach it from almost like an income standpoint. So if you have no clue about investing in stocks, right? So there's obviously the stocks where you can buy low and sell high, and that's what's the most popular thing for people to do. The problem with that is you don't really know what's going to happen in the market at any given point in time. So you could buy today, right, at $10 a share and be like, yeah, I got a steal. And then it drops down to like $4 a share for the next year or something like that. Realistically, it's going to fluctuate within there. But because of price fluctuations, you could be buying a stock for, you can buy and hold for a long period of time, and not really, because of your timing and because of maybe not doing enough research into understanding that the market is in a bubble, you could buy at the wrong time, and essentially only place you have to go is down unless you plan on holding the stock for a very long time. And what a lot of people will say to do, right? A lot of the smart people out there will tell you basically to do what they call dollar cost averaging, which is you want to buy consistently, right? And what that does is you might buy at $10 per share and spend $100 on the first month, right? And then the stock price drops to $4. So now you're still buying that buying $100 worth of stock, but instead of it being at $10, it's now $4. So you're buying more stocks at a lower price, which effectively lowers the price that you paid on the first month of your stock. So instead of that stock averaging out to be $10 a share, now it's somewhere around like $7 or $8 a share or something like that on average. And the longer you do that and the lower the price goes, the better, because it actually lowers the cost. It's almost like for anybody who has ever done any retail business or worked in retail, it's like when you buy inventory. As the inventory that you buy as the price goes down, you actually lower the cost of your overall inventory. Now, this could be a strategy that works for a lot of people, and if you're not the type of person who wants to stay glued to your stocks and just understand, okay, well, I'm dollar cost averaging, and in order to keep the average down, I'm going to just continue to buy all the time. The problem with that is, as I said before, if a company goes out of business, then you lost a lot more money than if you just bought one time and tried to sell. So realistically, that doesn't happen a lot, but it does happen. As an example, Sears has basically lost most, if not all of its stores. Blockbuster has lost. It only has, as far as I know, one store that's open in the United States right now. And 10 years ago, that was basically the only place where you could get a video, for you to watch at home. So businesses do go out of business. Retail is in some serious trouble right now simply because of Amazon taking over. So you have to really understand what you're getting into, which leads me to tell you my strategy. Now, before I tell you my strategy, I want you to know this is my strategy. I'm not telling you to do what I do. I am not a financial planner, financial analyst. I just am very, very adamant about doing what I believe is right, which is investing for the future, growing your income, making good decisions with your money, so on and so forth. And I implore you, don't just take what I say and run and do it. Do some research, and the best place to research my strategy I'm going to actually give to you. All right, but first, let me tell you my strategy. I am a strict dividend investor for the most part. Now, when I say dividend, what do I mean? So, unlike most stocks where you got to buy low and sell high, a dividend stock is essentially like almost like buying a rental property. right? If you guys understand what I mean. So when you buy a rental property, it's like you're paying a certain amount of money and then you get money consistently. All right. Now with dividends don't stay the same. So you could spend $10 on a share and the first dividend payment might be $1. The next one might be 50 cents. The next one might be 10 cents. The next one after that might be $2. So you really never know what the dividend is for sure. All right. However, there are resources out there that let you find companies that have consistently paid dividends that grow over time. So that's really what you're trying to do, is find a company that gives you a stable dividend, right? That company that gives you a stable dividend, and especially if the dividend grows consistently for years, right? They're more likely to continue to do the same thing, right? Because you're finding that trend. So one of the resources that I use is a website called dividend.com. So they publish a lot of information about investing in dividends, even some advanced things. But really, for a beginner, all you really need to do is understand a few of those lists. So one of the lists that I always look at is the dividend stocks that are 25 years, basically they've increased their dividends every 25 years. And I'll make sure I leave a link in the description for you guys so that you can find the dividend list. I also look at what's called REITs, Real Estate Investment Trust, and MLPs, which is Master Limited Partnerships. All right, and these are pretty much all of them give you a solid dividend. Now, don't make the rookie mistake, right? So the rookie mistake is this. They're going to publish on there what's called a dividend yield. Dividend yield basically tells you how much you can expect to receive as a percentage for a dividend. So if you pay dividend, if you buy a stock that's $10 and it has a let's say 10% dividend yield, then that means that every $10 that you put in, you'll get $1 back out when they pay their dividend on what's called the X date, right? Or X dividend date. So what I'm trying to tell you is the rookie mistake is trying to find the highest dividends alone. As I said before, a lot goes into this, especially when it comes to the strength of the company. You have to understand what you're really getting yourself into. You don't want to just jump into the thing that's going to pay you the most, because typically speaking, if they're paying 10% as a dividend, that means that for every $10 that they get, they're paying it out just to the people who invested. And at some point, that becomes a little bit more of a risk, because they have to use that money to grow, and that's really what you're looking for. And so you want to find a balance between a good dividend and a strong company, right? And so what I do is I actually find companies that pay high dividends. I mean, really stupid high dividends, because typically speaking, these companies will also have a very low entry point. So what I mean is, I have some dividend stocks that pay out like 15%, 20% or something like that, and they're very risky, right? And I know that going into it, but I'm lowering my risk because they're also maybe like $1.50, $2 or something like that. So you can buy $50 to $100 of that and get a good dividend, as long as the dividend stays up. Now, those will not be on the dividend list where the dividends grow every year for over 25 years. Those are going to be, like I said, more risky, because they could go up and down. They could go out of business. They could, there's all kinds of risk that comes with that. So what I do is I only pick a limited number of those, right? Because I don't want to expose myself to too much risk. Then I look at MLPs, which is Master Limited Partnerships, and REITs, which is Real Estate Investment Trusts. And those tend to have a decent dividend payment that they give, but you also want to make sure that you're not buying into too much of that either. So I basically break it up like into 25% increments. So regular stocks that pay dividends, I typically try to find something that pays above 3%, but you don't want to find something that goes really, it's going to be hard to find something like that depending on the time of in that business. So 3 to 5% is excellent for a dividend from an individual stock. If you can't find that, it's okay to take something lower, all right? And you really just have to kind of get your own feel for it. But these are more the regular dividend stocks that you have to pick. Individual stocks are going to be a better move if you understand basically how to read the financials of a company, all right? And now that, like I said, it takes some time. You can use dividend.com to study how to read certain financials. You can use, there's information everywhere. So yeah, that's what I would say. Learn about dividend investing, getting your dividends to pay you on a quarterly basis. And you can actually potentially even do it on a monthly basis. Now, since you have low amounts of income, the reason why this is a good strategy, at least in my mind, is that even though it's a strategy that takes time to build up, if you have a business like what I show in Starter's Formula, if you have a business and you take 40% of that income from your business and you use that specifically for investing, every time you dump in that extra money, it goes into your pot, and that grows your income or your dividend over time. And you only have a set number of dividends, maybe or stocks to invest in, maybe like 10. And you can even pick dividend funds or dividend exchange traded funds, which are called ETFs, which basically make it so that you're automatically diversified. It gives you a little bit more safety. But you know, primarily your goal is this. You want to understand what you're getting into before you get into it, and at least have confidence. Nothing is 100% safe, but have confidence that you know why you're buying a certain fund or a certain stock or a certain whatever you're buying into. And understand that you have to be able to, at least, I look at my stocks probably like once a week, sometimes once a month, depending on how busy I've been. But understand that the stock market is something that constantly moves. You're going to have to learn consistently. You're going to have to really take on ownership of making sure that you are building your income to throw into the stocks, and take on ownership of understanding your stocks. All right, now the stock market is just one way to invest, but it's a really good strategy if you're brand new to investing and you don't have a lot of money, as you may need with like real estate or something like that. You need a little bit more money with real estate than you would with investing in stocks. I actually started with just $40. All right, and I would say start small. If you only have 10, 20 bucks, start with that. The best app to use if you're brand new is actually a free app that allows you to buy and sell with no commission paid. And that's called Robinhood, all right? And you can just download that with Robinhood. But if you go to the link in the description, I have a link for you that actually allows us both to get free stock. So go ahead and click the link in the description, and it basically gives you a stock for free, and it gives me a stock for free. So we both win on that. Anyway, hopefully this made sense to you. If you have any questions about dividend investing, please leave a question down below. All right, and I'll make sure that I make a video, or I at least answer on the description, or excuse me, on the comments. So this is Mike Malbrough signing off. Hopefully you guys got something out of this video, and I'll see you guys next time. Peace.